that people get out of the habit. Learning is a habit at the end of the day. And, you know, as we try to learn things, it's difficult. I mean, I've tried to learn how to play golf and I'm rotten. I've paid for the lessons. I've got the best clubs around and I still can't play to save myself. I'm pretty crap at, but I'm getting better. That's the point. I am getting better. I can't compare myself to Lee Trevino. I can't compare myself to Arnold Palmer, Jack Nicklaus. I can only compare myself to how bad I was the day before and see whether I'm improving. But the point is that when you're learning something new after being away from learning for a while, it's really difficult. My daughter asked me to help her with a dissertation that she was doing for university a few years ago. And I had to remind myself how to structure a dissertation because I've been away from it for so long, of course. And I'm sure you've all been there if you've had grandkids or kids that have all asked you to help you with their homework or helped you with an assignment. You know, reminding yourself what is required inside that assignment is very, very important. So on that basis, learning is actually is a skill. It's just on its own right. It's a skill in its own right. And we've got to remind ourselves how to learn. And the reason why this is important is because we showed a technique and a process of doing a press trade the day before yesterday. And the idea was that we were asking everybody to do it again today. Make sure you get the press trades. And if you did those exact trades with the exact setups and structure that we showed the day before, you'd have made over $1,000 a contract in the London session on oil. Over $1,000 just by doing the exact trade setup that we did the day before. But obviously, the only way you're going to be able to do that is if you've learned the process and you're now doing the process. Because the problem is that as you get older, you probably know yourself, your memory drops off and it doesn't get not as sharp as it used to be. And obviously, in that sense, your note taking is terrible because you've been out of note taking for a while. You're not writing the notes properly. And therefore, when you come to put into practice the things that we're talking about, you simply are making mistakes because you've not written it down properly or whatever. I don't want to spend too long on this because obviously we've got a kind of short session today to get through this before 9 o'clock anyway finishes. On the screens, we've got the trade log. Obviously, that's just scrolling live on the right-hand side of the screens at the moment. But I want to talk a little bit about the intern to pro concept before we kind of get into the idea of market pricing. If we look at intern to pro, let's get through it very, very quickly. So I've broken it down. You're not going to get any fancy slides, guys. This is not my full-time job, believe it or not. Unlike an awful lot of people that teach in this space, this is not my full-time job. And when we look at this idea, you're not going to get fancy slides. You're not going to get fancy graphics. You're not going to get moving images. You're going to get a paint box, right? And that's it. End of. So we get cut to the chase. We say it as it is. And there is a reality about this as well. And everybody knows the reality of this. So, I tell it straight when anybody's in the room. If people have made a mistake, we call it out and we shout it out. Look, guys, that's absolute garbage. It's absolute rubbish. If you've not got that bit of business, why have you not? Think about why you've not got that business done. It's important that you take the idea that you're up against Goldman Sachs every day. You're up against Merrill's every day. You can't afford to miss the best opportunities. You've got to be able to take these deals and make sure you run with it, right? So with that said, intern to pro, let's look at the three kind of levels. And I've obviously just dropped down some notes here just to remind myself what we're thinking about when we go through this process from an intern through to the pro level. If you're in the bank, of course, intern to pro, well, when do you ever become a pro? Well, you become a pro when your trading pays for your life, basically going forward. You're on a trading desk and it's now paying its way. Okay, so the idea there is, of course, you may decide never to become professional and you're always trading as an amateur because you've got a full-time job and you've no interest in changing that, but you want to do a bit of trading on the side. You want to maybe make some money. As an intern, the key to an intern is obviously getting people to the first point. And obviously the idea of the intern is to learn about the concepts of structure and liquidity, the idea of learning about pricing the market properly so that the bids and the offers are clear, the idea of how to enter a fast auction and how to enter a slow auction, how to recognize what is fast and what is slow. And obviously as a key ingredient for the intern is to how to avoid Goldmans. You don't want to be trading against Goldmans or Merrill's or Deutsche Bank. You want to trade with them if we can possibly do that. So avoiding these guys is where the trade log comes in to help us, because that's obviously the most difficult part for an intern to understand at first. And then, of course, Becoming an intern, actually getting to the point where you're going to graduate through the intern ranks, requires that you do some practice outcomes. What are those practice outcomes? Finding real or possible big hitters. And we touched on this in classroom again earlier on today when we talked about the idea of recognizing that your edge is by recognizing where the big hitters are coming from. If you know where the big deals are coming, in other words, you know where Goldman's are located, well, that's your advantage. That is every floor trader's short-term advantage, is knowing where a big hitter's been or where they're going to appear on the screens. And we've obviously got some tools. You've all got some tools that can help us with that. The most obvious is volume, of course. So if we know volume's there, we can obviously recognize that that volume means something. Somebody with very large size did something. At this stage, of course, you've got no way of knowing what it is and what's likely to happen next. And unfortunately, in a lot of cases, price action doesn't tell us, it doesn't inform us about what's going to happen next. And we have to move on from that simple knowledge of volume to some other elements. So the practice outcomes for an intern is recognizing the real or possible big hitters, and obviously using that information to then price your market properly. And therefore, we practice the idea of being able to lean against a price, and we practice the idea of how to get involved in a momentum break of a price. The ideas that then can form the cornerstone of a trade going forward. As an intermediate, of course, we're starting to take some responsibility now for what's happening. So basically, all the same things apply as an intern. Of course, it just rolls over into your intermediate session. And obviously, the idea is that we add in the tipping price concept, the idea of going with the flow of trade, but not as a breakout type trader. Or breakout trades, you probably are aware, are one of the worst positive expectancies you can ever have. They occasionally make a fortune, and most of the time they lose a fortune. So there you go, positive expectancy of negative, massive. So when we look at this idea of adding a tipping price to the idea, we can actually take advantage of the concept of breaks, but obviously we can take advantage at a better price point during that narrative. How do we do that? Obviously, we can add a driver to this narrative. We can add the main key drivers of the day to this type of narrative. The practice outcomes we get from an intermediate is pretty straightforward. As a practice outcome, we practice pricing the markets, just like we did as an intern. We practice pricing the markets, but not based on price action, not based on structure, but based on information that's also outside of the normal price action and structure. So in other words, we price the markets from prior knowledge, and we price the markets from current knowledge about what an informed trader would be doing. And obviously the idea of entering the market from the tipping price, therefore recognizing the momentum, allows us to take advantage of the new pricing that we have on the market at that stage. Moving through the intern and intermediate exercises, now your knowledge is starting to build into the point where you start to recognize why in certain liquidities, why certain liquidities are used to buy for a reversal and why certain liquidities are used to sell for a continuation, for example. Are we going to get a volatility expansion, or are we going to get a volatility contraction as price rebalances inside the middle of a balance area, prior balance area? So this all starts to develop, and you can actually start making money through this process, obviously, as you start to take some of these trades, once you start learning some of the basics of these ideas. You might think it's really basic for you. Perhaps you've got a lot of experience as a trader, and good for you. I mean, obviously, you've been successful up to now, or maybe you're starting to find that the markets are changing and maybe the success isn't as good as it used to be, and therefore you're looking for that additional edge. Of course, everybody is. But you never stop learning, though. That's the point. I don't stop learning. Every day I learn something new. Every day I pick up on another idea, another idea, another idea, and I keep building around it or thinking around it to see if it gives me any additional edges. And if it doesn't, you chuck it in the bin. Most things don't give you an additional edge. What I'm not going to do is sit here and tell you that by the end of this course, you're going to be a massively successful trader, because that's on you, on how much you commit into the process. And even then, you still might not be a great trader, guys. I don't know. I've spent thousands and thousands and thousands of pounds on golf lessons, and I'm still not a good golfer. I still couldn't compete in an amateur competition and still have a chance of winning it, never mind a pro competition. And that's golf. That's golf. That's not trading against Goldman Sachs. That's just a round of bloody golf, right? So when we think about this as an idea, just because of the money that I've spent, on these lessons and these brilliant golf clubs, I've still got to swing the bloody thing, right? I've still got to swing the club and make contact with a stupid wee ball. You know, and when you come from Scotland, it's pretty bad if you can't play golf. You know, it is a kind of given that you should be able to have a round of golf, especially when the Americans come over and visit and they say, right, what golf course are you playing? And you say, I think I'm busy that day. So, you know, the Americans expect you to be able to immediately pick up a set of bats and play golf, right? So when you think about it, pro, when we move from intermediate to pro, what are we talking about? We're trying to improve ourselves against ourselves, not against anybody else, against nobody else's ideas. We're trying to improve ourselves and our positioning and our profit profile. At the pro level, we want to be consistently profitable to the point where we're making no errors, for example, on pressing a buy instead of a sell. Our charting is now clear. We've got a good idea about what's happening. So as we enter the pro section of the idea is we start developing a knowledge of this fundamental process, some of the fundamental drivers in the background, which obviously you can't chart. All you can do is read the news and get to know and understand. Well, how do you get to know and understand? Well, the best way is simply to start from today and start exposing yourself to the news itself. Start getting a news feed, start reading the news feed, start getting into the calendars and start recognizing what's good and what's bad and the type of effect that it has on the market. Start talking about the same things that the big pros are talking about. Start talking about inflation. Start talking about recession. Start talking about whether it's a good number that's bullish for equities or a bad number that's bullish for equities, because it sometimes changes, as you probably know if you've traded equities or bonds recently. So as a pro, we develop this understanding because by now we've spent some time around it as an understanding process. And then, of course, we start adding a more complete market view. What is the dollar doing to my pricing? What is the bond prices doing to my pricing? What is the inflation outlook? What are the linkers doing? What are the 2-year linkers doing to my pricing? What are the crosses doing to my pricing? There's always more than just one thing. There's always something else that can be going on, which is causing the effect that you're seeing on the charts. It doesn't just happen randomly. Although some people might think it's a random idea, it's certainly nothing but random. It's got a lot of information when we see these things happening. And obviously this then leads us to what the pro starts to learn. Well, the pro starts to learn all about spread trading. They start recognizing that as a pro trader that you have more than just the outright opportunity to buy a bond at the bottom edge. We showed you that bond, and you might look at the bond against a gold price or a bond against an oil price or a bond against an equity price, and you might say, well, I think there's a bit of value here, but is the value in gold? Is the value in bonds, for example? You start looking at that as a possible problem because you don't know which one is driving the market and which one is lagging the market, because what is to tell you which is moving which? So as a trader, you start recognizing the value, for example, of spread trading. And obviously the value of spread trading allows you to then look at a market from the point of view of perhaps it's both. Perhaps I want to buy some bonds and perhaps I want to sell some gold. And you maybe start thinking about that as a spread trader, but at least you've got an appreciation of these elements before you start making decisions. And obviously from that develops into the type of trades that we do as a pro trader. And there are two very, very specific, or rather 3 very specific trades we do as a pro trader, which we haven't done at this stage as an intern. We've started to learn as an intermediate, but we haven't done yet until we reach the pro level. And the 3 very specific trades are, of course, what we call the BSG squeeze, which is obviously a very momentum-based trade. It's a very, very order flow-based trade. So we need to understand order flow very, very aggressively. We need to understand the pulling of the book, predominantly the pulling of the book. And we need to understand the speed that we've got to respond to for these BSG squeezes to make sense. In the olden days, if you were on the back desks or even on the floor of the exchange, these are the types of trades that the markets the traders would try and make 2, 3, 4, 5 ticks out of, and that's their entire trade idea, is to make the bid offer spread back on those types of trades as a BSG squeeze. Nowadays, they can be turned into spread. They can be turned into to momentum trades with swings attached to them. You could go for measured moves and all those kind of things as well. But at least it starts with a BSG squeeze. The second trade, of course, that we learn is the trade that we talked about in the last few days, and it's the press. And the press trade should be the most voluminous trade you do every single day. The press trade should be the trade where 80% of your trades perhaps reside. And if you look at my bond chart, if we go back to that tweet we sent out last night about buying bonds, and obviously this morning we've been buying lots of bonds, you'll see that this is the fade trade. This is the pro-fade trade. It's pretty straightforward why it's called a fade trade. We're buying a bottom edge. And this is actually the hardest trade in the book. For anybody that's tried to buy a bottom edge, you can see from the background chart here, it is quite clearly the hardest chart on the book because it obviously lasted, for 15, 16, 17, 20 hours, the bottom edge fade, 20 hours. So this is the trade that would drive most retail traders demented. This is the trade that the vast majority of retail traders do, but they do badly because they're not using the right technique to fade the market. And initially, we try and get everybody off the fade trades. The interns aren't allowed to do fade trades. They can only get into the fade trade when they understand the concept of pricing and pressed liquidity. The pressed trades are these arrows here. That's a press, that's a press, that's a press, that's a press, and that's a press. So you can see at this stage here, I've done one fade at the bottom edge at the London Open, and then 1, 2, 3, 4, 5 pressed trades into the measure move. 5 pressed trades. And then into the bottom edge, I've got a fade trade. And then we could actually start arguing whether this is a fade or a press. Obviously, it starts to become a little bit pointless as an exercise at that stage anyway, about what it is. It is just a trade at the end of the day. Regardless of whether you've used it as a press trade from a previous trade, you can obviously look in the background and you can see that this press level is very important to us. And obviously, this is an idea that you start to develop out where the bids are likely to be located. And when you see it coming in, you've got a great idea to buy into that as a press trade opportunity. So it's not a fade trade. And the reason why it's not a fade trade is because there are prices below us. And that's an incredibly important point when we come to pricing the market properly. And this was a press trade as well. And we got a nice top edge. And that's the end of that trade. We're still buying dips, as we suggested to you earlier. We are still a buyer of bonds on dips. Anyway, so what is this about pricing the market? We've obviously talked about pricing the market on a number of occasions here in the interns and the intermediates. And obviously, as we start pricing the market properly, we start understanding the idea of what the trade log is all about. Because if you don't understand that, there's no point in having the trade log. If I tell you that I'm bidding bonds, does that have any value for you? Sure, of course. If I'm bidding bonds, then you've at least got an idea that I'm bidding bonds, but you haven't got a clue about what price. So in other words, unless you can price the market, or unless I tell you what price, you're still in the dark about the fact that we're bidding bonds. I mean, you've still got to find that price idea, haven't you? So some people might say, well, okay, I kind of understand that. I kind of get an idea around what we do in terms of going from this intern to pro. We'll come back to that when we wrap up today's session. So when we think about this idea of pricing, I suppose the big question that most people have is this question here. Is pricing the market accurately actually important in the first place? In other words, do you believe that it's possibly the most important skill to be able to gain as a retail trader? Is it the most important skill? Some people might say yes, and some people might say no. My own opinion is it is probably the most important. Now, obviously, everybody's requirements are different. But if you can't price the market properly, it doesn't matter whether you're good at everything else. You're going to be losing money more often than not. Let me think about this for a second, and let's diverge our attention a little bit away from markets and think about this beautiful looking car. Okay, so there's a beautiful looking car that you've just seen in the car lot. It's called a Ford Edge SE. It's not just the standard basic model, it's the SE. It's got a very small 132,000 miles on the clock. It's a 2017, and you can see it's in pristine condition, and it's a 2-litre. Now, your job is to flip the car, not physically flip the car. I suppose some of you might be in the strongman competitions, but your job is to flip this car. You're not intending to buy it because you've just found out that your wife is pregnant with a 3rd child and you need that extra seat. Bang goes the 4-seater, right? So you've got to get that extra seat, and this Ford Edge suddenly becomes the perfect solution for you. But your job is to flip the car. Well, it's the same as the markets. Your job is not to buy lots and lots of oil. Your job is to flip oil in the next 15, 20 minutes, or even an hour, or even the next 60 seconds. So how can you flip this price? Well, obviously, you look at that car. In what I want you to now do, and it's got to be an accurate price, of course, because obviously if it's not an accurate price, you're not going to be in the party, are you? I want you to put a bid in for that car, and I want you to put an offer in for that car. In other words, I want you to look for a price that you would sell this car at as a flipper, and I want you to think about what price you would bid for this car as a flipper who wants to buy this position, right? And I want you to actually go ahead and bid for it. Bid an offer for this car. I'm not going to hold you to it. It's not my car. So obviously, and you might say to yourself, what? Exactly. What information are you already missing? You haven't got anywhere to value this. You've not got maybe any means to value this unless you happen to know the Ford Edge 2017 SE SUV, right? Unless you happen to know what the underlying current market for these cars is, right? So you might be looking at that and saying, how do I bid for it? Go ahead, bid for it. You've got as much knowledge as most retail traders have about the markets at this stage. You know what the market is. The market is oil. You know what the current price is. It's $85 a barrel. You know what the time of the day is. It's such and such a time of the day. So you've got to bid for your oil. You've got to offer for your oil. So go ahead, make a bid for this car, make an offer for this car. And I want a two-way price. If you're the market maker, I want a two-way price that's going to give you a profit. Two-way price. Now, obviously, for some, guess what's going to happen? You're going to look at this car and see if this makes sense, guys. See if this makes sense. I hope it does. I spent all of 5 or 10 seconds coming up with this idea as an exercise. So see if this makes sense, guys. So you're looking at this car and you're saying, right, what's the retail value of this thing? I don't know. What's the retail value of this car? Because obviously the idea here is you want to sell it at retail and you want to buy it with a big discount, or you want to sell it below retail. Because obviously you might have to sell it below retail just to get your money out of this particular vehicle. So you say to yourself, well, I don't know what the mid price of this car is. So you have to know that, don't you? In other words, you have to know what fair value is, correct? So the first thing you're going to be asking from a market is, what is the current fair value of that marketplace? The second thing is, what kind of discount can I get to fair value? And can I flip this against that fair value price? Can I get a premium against that fair value price? Now, obviously, if I said to you, and if you've made a bid and an offer for it, this is your last chance to type in what your bid and what your offer is for this car. Type in the bid and the offer. Now, the idea here is it's got to be realistic, because obviously if I tell you that the actual fair value on this car at this present moment is a whopping $10,000. You may say, what? I didn't make the rules, guys. It's in an auction site, right? That's the current fair value price for this car is $10,000, right? So some of you might have said, I'm going to bid $2,000, right? Some of you might have said, I'm going to bid 2K and I'm going to offer, say, for example, 20,000. I'm going to sell it at 20,000, okay? So you've just bid 2,000 and you're offering 20,000, right? You're selling at 20, you're buying at 2. What's the chances that you're going to get any of those two trades based on a fair value of 10 grand? Zero, right? It says zero. You might be incredibly lucky that nobody else turns up for the auction and suddenly you get this car for 2 grand. Well, congratulations. It doesn't matter if you sell it for 3, you've made a massive profit, right? But what's the realistic chances that you're going to get this car for 2 grand? Very slim indeed. So in other words, when you start thinking about pricing, it's very easy. So what we call the traders that do this bid and offer is, we call these guys hiders, right? Okay, we call these guys hiders because they're hiding away from the current price action. They'll never get filled, but they're bidding and offering, and they feel as if they're connected to the charts. They feel as if they're involved, but they're never going to trade. Realistically, they're never going to trade because they always keep themselves away. They hide from the opportunity. I know a lot of traders that have done this. A lot of interns do this because we tell every intern when they come into the desk, I want you to see your bids and I want to see your offers. And they've got to have a bid and they've got to have an offer. And because of that, they hide. They move their bids so low and they move their offers so high, they're never going to get filled. They're never going to get obviously they're never going to get identified as a winning or a losing trade because they never get filled. And their suggestion to us then is, I never got my price. I never got my price. No, damn right you never got your price. You were bidding a ridiculously low price. Of course you're never going to get your price. But did you make any money? Because at the end of the day, you've still got to make some cash here, right? You've still got to make some cash. So getting the price right involves actually getting a price that's accurate as well, not just a low price, not a low ball. You've still got to get accurate. So realistically, the realistic answer to this is, of course, that you would bid something maybe around the idea of $9,000, right? Because obviously, if all you get is fair value, you can still walk away with $1,000. And the idea is you'll bid $9,000 and you'll maybe offer 11, right? You'll maybe sell it for 11. So you can see that you're getting closer to that fair value price. You're getting very close to what is a fair value price. And now there's a very good chance you'll actually get filled in that trade. Now think about what you would have bid. Hold on a second.
We're back in school.
Okay, so let's get back to this. So you can obviously understand that, the idea of hiding away from this price, the idea of hiding from this price itself allows us to think about the idea that perhaps we don't know what the value is. So for example, if you've got no way of knowing what a 2017 Ford Edge with 132,000 miles is on the clock, if you've got no way of knowing whether that car's worth any money, then of course you put in a low ball. You say, well, I'm not going to be willing to commit anything above $5,000, right? So you bid $5,000 for it. You think you should still be able to make some money if you can bid $5,000, but realistically, the chances of you getting filled at $5,000 is still very slim. So what is the takeaways from this exercise if you decided to play along? What is the takeaways? What would have been really useful for you to know? You'd have been really useful to know what this car really is actually worth. In other words, what would have been useful for you to know is to know what these cars went for in the last week or two, right? If you were to look at a garage forecourt, a retail garage forecourt, not an auction site, what would these cars fetch on a retail garage forecourt? And you might look at that and say, well, they're looking at around about $12,000, $13,000. And now you're starting to form a knowledge, aren't you? Now you're looking at a wholesale price of about 13, 14. You're saying maybe 11,000 as a sell price is a little bit too aggressive. Maybe I could probably get a better price. Maybe I'm a little bit too low into this as a flip. Well, fair enough. If you want to try and get your money out very quickly, then a sell at 11 might work for you perfectly. But the point is, you've got to know all about this car before you can trade it. You've got to know what the auction's doing. You've got to know what kind of auction you're stepping into. Because you don't want to bid $9,000 if nobody else is available, right? If nobody else is bidding, you don't want to bid $9,000. You want to maybe say, well, you know what? I might get a chance of buying this for $5,000. And obviously, the lower you can buy it, the far better you can buy it. So the auction itself is incredibly important. Not just the value of the car, the auction is incredibly important. Because if you've got a brilliant opportunity to buy very, very low in terms of this outcome, then of course the chances are that even if you've got the outcome wrong and this car's not worth 10 grand fair value, if you've bought it at 5, you can still get away with a profit in this deal, right? So we come back to that question that I posed at the beginning. Is the pricing of a market accurately important? Well, do you think you could flip cars if you didn't know what the book value was on these cars? Do you think you could honestly flip cars for a profit if you didn't know what the book value was? I mean, you lowball it, you never get traded, you never buy anything, you never do any stock, and you never take a chance, right? You never take a chance. So the answer, I would imagine, and anybody with any brains would answer, is that the most important aspect of trading is basically being able to price the market properly. So if you look at this chart here, I posed this question to everybody in the room this morning. Give me a bid and an offer on this chart. Remember, we're always asking for two-way prices, guys. Give me a bid and an offer for this market right now. In other words, bid for it. Give me a bid and an offer. Now, what's missing from this information? Well, I haven't told you that fair value is that black line in the middle. Fair value is the black line in the middle that runs through there. That's fair value. So now you know what fair value is. What else is missing? I don't know whether the market's been rising or falling, so I don't know what kind of auction I'm stepping into. All I'm getting is a snapshot of an auction. So therefore, I'm limited by the knowledge that I've got available at the moment. I'm limited. So therefore, take care and give me a bid and an offer that seems realistic. Think about that process for a second and think to yourself whether you do this as a trader just now. If you step onto your charts, are you actively pursuing that bid and offer price? Even if you're bullish, you should still know where the offer is. Because if you're bullish, an offer gives you an idea of where your profit take might be located, right? You don't just price the market with one side, you price the market with both sides. So when we look at this as a trade, the simple answer, as far as I'm concerned at the moment, is I would bid the zeros, right? I would probably look to bid the zeros. And I would look to bid the zeros, and I'd look to offer the 60s, right? So you would look at the zeros and the 60s and say, well, realistically, a bid below zero would be fantastic, and an offer above 60 would be fantastic. Because if this is fair value and this is where somebody sold that before there, because we can see that's where somebody sold it, and if somebody bought it the last time here, then that looks good. That looks like a good price to pay for this bit of business. Now, take a look at what happens next. Take a look at what happens next, guys. We go from this 30 print, and it's now trading 10. Okay, so we're now trading at 10. I want you to price the market right now. I want you to price the market right now with a bid and an offer. Now, what I want you to think about is whether you do this. Whether you do this. Now, the guys in the classroom should be doing it because they are learning about this process, of course. But for the guys that aren't in the classroom, that haven't joined us, the question that I've got for you guys is, do you do this process? Are you pricing the market in this way? Price that market for me. Put a bid and an offer in. It's a question we ask every intern to see if they've got any knowledge of this as an idea. Price the market, two-way price, and let's see if you hide from the trade. Let's see if you're confident about the trade. It's easy to hide, isn't it? Because I could say to you guys, price this market just now. You might say, well, am I a buyer or a seller? Well, that's not what we're asking. I'm asking you to price a two-way market for me. So it doesn't matter whether you're a buyer or a seller. I just want you to price a two-way market. There's also something else that's missing. We don't know what the current fair value of this line is either. So we're pricing it not because of fair value. We're pricing it because of simply the auction that we're involved in here. So we're trying to learn about pricing the auction. So go ahead, price it up. If you can't price it, I think you probably need to join us, or at least learn this process from this little classroom session. If you can't price this accurately, you need to have a real serious think about what you're doing as a trader. You should be able to price the market very accurately at this stage. Okay, so we've just went from 30 to 10. If you've ever been involved in any concept of game theory, it should be relatively easy for you if you've ever been involved in game theory as an academic study or as a actual professional study as a trader. A game theory suggestion would be, of course, that this is a Nash equilibrium, that therefore, unless something happens that's not visible at the present moment, unless something changes, then, of course, if we went from 30 to 20, we obviously we know exactly where we're going to bid at this stage. We're going to bid 90. We're going to bid 90 because that's what the Nash equilibrium tells us to bid. And if we're going to bid 90, I'm going to start offering 10s, perhaps a little bit higher into maybe 15s. I'm going to offer the 10s and the 15s. Okay? So you might be saying, well, okay, that's kind of an impressive idea because obviously now we start to see where the bids and the offers should be. We start recognizing what we should be trying to do. You can see that you're not hiding from a trade here. You're obviously trying to be short, and you're trying to be short in a sell market. Well, that makes perfect sense, doesn't it? It makes perfect sense. It doesn't mean you will buy at 90. It means that's what you're bidding at the present moment when you were asked to make a bid and an offer. As the price trades perhaps towards 90, you might have a different opinion. And as the price trades towards 90, of course, the Nash equilibrium may suggest that the price is going to go beyond 90, of course. So when we understand that as a process, and obviously the price then does trade towards the 90, the idea is if the price were to trade towards 90, and the Nash equilibrium, depending upon what happened to the trade as it went from this point to this point, we might say, well, if the Nash equilibrium is still moving, then of course all you're going to do is say, well, I'm going to go again, guys, and I'm going to go 90, and I'm going to start bidding 70 now. So you're not buying at 90, you're now bidding 70. And if you're now bidding 70, you're now offering, of course, 90 95s. You see what's happening? You're creating a chart with your bids and offers. And this comes back to this idea here. Is the pricing that you make responsible for the shape of a candle? Now, a lot of people that might say that the pricing isn't important to the first question, this is obviously where we come back to you and ask you the question now. Is the pricing responsible for the shape of a candle? Yes or no? Well, think about a market. Think about a theoretical market that has no other buyers or sellers except for you and one other party. You're the market maker. You're the guy that's trading on the bid and the offer. You're buying at the bid and you're selling at the offer. In other words, you're making the market by providing liquidity on the bid and the offer, correct? Okay, so you understand. The other guy trades with market orders. So in other words, the other guy trades against your bids and offers. So at this stage here, you're looking at a random market and you're saying, I'm selling at 50 and I'm bidding at 40, right? I'm offering 50 and I'm selling at 40. So do you create the shape of the next candle? Theoretically. And therefore, based on the theoretical construction that we're just painting, does the combined logic of the market create the shape of the candle? Well, fair value at this stage must be very obvious. It must be 45, right? If the offer price, which is obviously at a premium you'd imagine, is 50, and the bid price, which you would imagine is a discount price, is at 40, then of course you would imagine that fair value must be 45. So now we've got an ability to create and understand how to find a fair value price. Fair value is currently 45. Now, obviously, why would anybody then sell at 40? They obviously have a different opinion about fair value, right? They've got a different opinion about fair value. So obviously the guy comes in and says, you know what, I like that trade. And they sell at 40. They sell at 40, the only available bid to sell into, right? So they sell at 40. So what are you going to do? Well, obviously, if the offer was at 50 and they've now sold at 40, what do you do as a market maker? As a market maker, you say, right, I've got long at 40, so I'm going to try and sell at 42. I'm going to try and sell at 42 for 2 ticks, right? I'm going to try and sell at 42, and I'm going to pull away my bids to 30. Why? Because obviously somebody decided to cross a spread, and you're now wondering why they thought the price was going to be going lower. So it's almost the same as what happened during this seller coming back in here. Obviously, the fact that they did come back in from the bottom edge rather than the top edge suggests that they know something that you don't, perhaps. This might be an informed seller. So obviously, because that may be an informed seller, you're not wanting to take a chance as a market maker and you pull your bids down to 90s. So does this create the shape of a candlestick? Well, let's assume that the last traded value, the last traded price was 50. The last traded price was 50, and of course now you've just traded 40. Of course, the candlestick now looks like this. We go from 50 to 40 because that's where they got filled, right? So obviously, if the next trade is at 30, assuming they still like the trade and they still think it's bullish, then the next candlestick will look like that, wouldn't it? If I bid 35, the candlestick would be a lot smaller. If I bid 39, the candlestick would be a tiny little bid offer spread candlestick, correct? In other words, is my pricing responsible for the candle shape? The answer is yes. So we work our way back to the logic of the first question. Is therefore the pricing of the market accurately really important to you as a trader? Well, the answer must by default therefore be absolutely imperative that we get this right. Absolutely 100% that we get this right. So therefore, recognizing that we must get this right if we're going to flip the market properly, what do we need to know? We need to know what fair value is doing, just like our Ford Edge earlier. We need to know that this car has a fair value of 10 grand before we know how to bid an offer for this. We need to know what the shape of the market is. Is nobody buying cars just now? Is there a chance that the value is going to fall dramatically in the next few weeks? So I don't want to have this car in my stock because there's maybe a brand new model coming out. The price of these models is maybe going to go down even further. Or there's a ban coming in cars that have done 132,000 miles, or so on and so on. So I've got to be aware of those macro fundamentals in the background that also might affect the value of this car. So we've got to start thinking about the markets in terms of that type of knowledge, the ability to properly understand what fair value is, the ability to then price our markets accordingly, the ability to not just price our markets accordingly, but to recognize that some other traders have done the heavy lifting for us and priced the market for us. And obviously, if you remind what happened on the Treasury bond, this blue line represents our fair value, right? So the blue line represents my bond fair value. So if this is my bond fair value, and I can see that I'm getting these heavy discounts to that fair value, is it therefore reasonable that with these heavy discounts that I've got a very good proposition to buy into? And those discounts actually kept improving as the value improved. As the fair value improved, those discounts became even more valuable to me. Gimme, gimme, gimme. But you've still got to put a bid in. You've still got to put a bid in based on how the auction is evolving, based on the volatility. If I bid this volatility too early coming into that 1,500 hours data, I could have got very badly burned as the price then spiked down to the lows. But I knew there was a volatility expansion at that time, and I didn't get involved in bidding too high a price. I just put my bids at the same low. And obviously, that's all I was doing, is putting my bids in at the same low. If the price never got there, then I could obviously bring my bids into the price more accurately. I got lucky and I got filled at the same low as I was getting the last time. So that's just luck. Where would I have been willing to bid for this? Well, you can see with the value now coming into that fair value area, I'd have probably been willing to bid for this probably just below 126 evens. So if I'm willing to bid for it below 126, you can see how much discount I got at 125.20s. $300 discount. I like that type of trade. I like that type of trade a lot. And you can see that what's happened since then, of course, is that with this valuation spiking down, and I'm still now thinking about the discount being around about this 31 print, and with the value then going up, I'm still looking at this. Some sellers thought it was still value to sell it. I've got to still look at this as a discount price area. You know, have I got a big enough discount because of what's happening subsequently? This short-term seller coming in, suggesting I don't want to buy back in here at twos. You know, if that short seller's coming back in, I'm going to be more interested in bidding back into this 30 print, right? So the break of the zero allows me to bid back into this as a bit of business. So we just come in for a bid there below 126 evens. So therefore, pricing the market becomes incredibly important that we get it right. Let's do a little exercise on the S&P to understand this a little bit further. A little exercise on the S&P. We're going to add in a little bit of volatility at times. We're going to add in a little couple of question marks, but I want you to price the S&P on the right-hand edge here, guys. There's no point in looking at the current chart. Just price the market properly, guys. Just give me a price. So come up with a bid and come up with an offer that you would be willing to trade this current S&P on the right-hand edge. Imagine you're just gone live and you're trading. Would you like to bid this at 89.5? Would you like to sell this at 94? Of course, you'd love to sell it at 94, I'd imagine. But do you want to bid it at do you want to bid it at 89.5? Do you want to bid it? In other words, do you see how important this is? If you don't know the answer to this question, you need to know the answer to this question because you're a trader. If you don't know how to bid for this at this present moment, you can see where your problems are, right? So if we're using the concept of the Nash equilibrium, you've got plenty of time now to think about your two-way money. Now, you might be saying, we never had enough time. We never had enough time. Guess what, guys? You don't get enough time as a trader. You've got to make that decision literally within seconds, if not perhaps even fractions of a second if it's moving that fast, right? You're entering a very fast money auction. Very fast money auction. You've got to price that market really, really quickly. So what's your bid and what's your offer? Did you get filled on the next candle? Did you get a trade done in the next candle? Well, if you're using the Nash equilibrium and you followed the exercise from before, you would probably be looking at this and saying, I'm going to bid and I'm going to offer. So you're looking at 89.5. You're probably going to look to offer into this area here, right? So I'm putting it to the left so that we obviously understand. So you're going to be looking at that and saying, well, I'm going to offer some at 89.5. I'm going to offer some at 90, and I'm going to offer some at 90.5. So you've just got your offers on the screen, right? Why would you offer those prices? Well, look at the damn candle. It's an incredibly aggressive, volatile dropping candle. So obviously, if you've got ways of verifying what that price is, you've got a great idea about getting into that deal and going with it, right? In other words, you've got a trade. You've got a trade opportunity already presented on your screen at that stage. Sell it at the close of that candle. If the Nash equilibrium doesn't show any value change, we now know that on the basis that this price dropped by approximately, obviously, if we just look at it at 90, you just, as a local, you just do round numbers, guys. You don't do halves. You don't do quarters. You just go round numbers and just give yourself a bit of an edge on these trades, right? So you go 93 to 90, worst case, 93 to 90, which is 3 points, right? So 3 points, you can take it back off the 90, 89 there, and you say, right, I'm going to bid 86. Agreed? You're going to bid 86. Anybody not see that? Anybody not understand that little process there? So you've got an offer in and you've got a bid in. Does that determine the shape of the next candlestick? Assuming you're right with your bids and the offers, the answer is yes, it determines the shape of the next candlestick, right? Assuming the rest of the market agree with you, you should be absolutely spot on correct with this assessment of the current bid and offer that's starting to show up on the screens. And obviously what happens next is the price then trades towards your bid price. You've obviously got a Nash equilibrium in this candle, this candle, and this candle. You reassess your bids, you reassess your offers, and did you get filled on your sell? Sure. You got filled on your sell at every price during that move. Now, if you'd been hiding, of course, if you'd been hiding from this trade and you says, well, I'm going to sell at this price here, we would all love to sell at that price. Of course we would. But you're not going to get filled very often, are you? In other words, as a local, you've got to bid and offer around the current price. You've got to know whether you're aggressively offering or pulling bids or vice versa. Well, the Nash equilibrium already told you what the trade should be. And obviously what happens next will then inform you about how that Nash equilibrium is unfolding. The next candle was a lot smaller. So that's suggesting that this bid is probably good, right? Because that candle was a lot smaller, this looks like a good place to leave your bids, because even in a Nash equilibrium at this stage, the pullback here was maybe to 90 and the bottom edge here was 88s. 88s to 90s, 2 points, right? So 88 offered, you're looking at a price of 86. So that still forms that same bid price approximately, and it's just an approximation. Remember, as the price drops to 86s, you can always pull it if you wanted to. You can always pull away your bids if you wanted to because you think it's going to keep going. And obviously, as the price evolves there, you can see the price did pause. It did jam into that area, but it did carry on going. But that's, as I said, you're not bidding this price. You're just putting the price in. The trade you actually took was a sell trade. And every candle that forms creates this concept of a Nash equilibrium. Is the Nash equilibrium turning out to be true? What kind of auction am I stepping into? Do you all recognize that the auction starts slowing down? Okay, so let's imagine you started to put a bid and an offer on this candle here. Let's go back to that candle there. Right, that little candle. Give me a bid and give me an offer. Now, you've obviously seen what's happened, but you can obviously still do the exercise based on purely price action. Now, we don't do it based on purely price action. We do it based on order flow, price action, and relative value, fair value narratives, right? So there's three elements that tell us what the fair value is. So if we're looking at this, we could say, well, we're selling off of, perhaps we're selling off the 86.5, and perhaps the bottom price was around about 84.5, so that's about 2 points. So I'm going to bid 82s, right? I'm going to start looking at that and saying, well, based on that 2 points, 85 was a close. Let's just put a bid in at 83s. It's slowing down, so maybe it's going to be a little bit higher than 83s. We'll maybe go 83.5. Okay, so you start adjusting based on the auction you're seeing. So you're going to bid some 83.5s. What are you offering? Well, with the slowdown, I don't want to get too aggressive into this. I'm going to offer 85.5, 86s. I'm going to offer 85.5, 86s, sell side. And did you get traded? Well, you traded 85.75. So yes, you got traded. You got filled on your sell trade. And obviously your job now is to try and find if you can get into that value narrative at the bottom edge. This candle starts changing your opinion about your ability to achieve the bottom edge. You can see that there is somebody absorbing on every tick, and you say, well, I don't think 83.5 is valid anymore. I'm going to start bringing my bids back up to 84 now. You see how you start forming an opinion based on how it then develops, not based on the idea that it should do this and I'm going to stick to it regardless. You start forming your opinion about that pricing structure based on the type of auction that you're seeing, based on the value, based on the order flow that you're seeing. And obviously at that stage, you get your fill. You get the fill you wanted at 84s, and you say, right, I'm happy with that. I'm happy with an 84 fill. I think that's a good price. And obviously anything below 84 might be now a discount to start thinking about possibly a buy reversal. And the price obviously at that stage did reverse, and it reversed really aggressively, which is kind of crazy considering the simple logic that you would have used to find the possibility that that was an end game. What else formed your opinion? Did the drop-off in volume help to form your opinion? Did the lack of sellers at lower prices form your opinion? Did the slowdown in the overall market form your opinion? Of course they did. In other words, it's not about one thing, it's about seeing that overall view, but you only see that overall view by being exposed to the question in the first place. How to accurately price my marketplace? And of course, the next question is there likely to be a big Goldman Sachs buyer at this bottom edge here? If there is, I want to be a little bit more careful about selling into it. So we come to the next question. I'm sure there was another question on the chart. I don't know where it is. There it is there. Okay, there's the next question, guys. Price the market for me. Price the market for me. You see how easy it becomes? So you've got a top line at 88, so you've got a bottom line around about 82s, you're about 6 points. So you're looking around about 76, right? You're looking at a bid at 76 just now, correct? So you've got a bid in, you've actually got an accurate priced bid into the markets based on that knowledge, correct? 76s. What are you offering? Well, of course, you can obviously understand that this was that prior swing low, of course. So you want to be a little bit careful about offering too low into the price at that point. Perhaps a little pop into this and maybe 83s, 84s, 85s. You maybe say, I'm going to offer some 83s, 84s, 85s into this. I like the idea of that offer. And if you're hiding from the trade or you don't think that was a correct drive to the downside, you might offer a way up here at 93s. Can you see how some people get successful in trading and some don't because they're hiding from those and they're purposely trying to avoid? I've seen it actually watching kids' sports. You know, when my kids were growing up, we went along to a lot of sporting events and we watched the kids' sports and we were looking at the kids that would hide from passes. So there would maybe be a football game going on in the background and you'd watch to see where the little chaps are running into. And you're saying, well, why does that guy always follow his marker? Why is he following his marker? He's got to get away from his marker. He's following his marker so that he can always claim that he didn't get free. And if the ball gets anywhere near him, the marker gets the ball and he goes, damn it, that guy was really on me. That guy was keeping tight to me. He never tried to get away from that marker. In other words, he was hiding from getting the pass and therefore he could never be seen to be making a mistake. Recognize if that's you as a trader. Recognize if that's one of the character traits that you've got, that you constantly hide from trades. we encourage the locals, we encourage the interns to overtrade. Some people might say it's a terrible habit to get into, but I'm telling you, not trading at all is an even worse habit as a trader. By overtrading, you can learn to do this on a demo account, learning to find these trades. The only way you'll see these trades is if you're physically being encouraged to take a deal. I don't care if it's a demo account or if it's a micro account. It doesn't make any difference. You're using that idea of looking for what you're trying to answer at that point and then getting involved in that process. So obviously we've now got our offer in place. Did we get filled on the offer on this occasion? No, we didn't. We never got filled, guys. Boo fecking who, right? We never got filled. So there was no sell trade for us on this occasion. We were a little bit too cautious. So we never got filled, and we learn about that as a process. When this trade came in here, you can see if you tried to sell above 80, you never get filled again. And obviously this is still a possible bid price. And what happened? Interestingly enough, the price traded into this bid price, and yep, the price went up. We weren't forecasting that price was going to go up, but we had an idea. And did we start to recognize that auction change? Did we recognize the slowdown in the auctions? Did we recognize that somebody was starting to buy into those low edges, into that very obvious bid price? Absolutely. Would that mean that you'd be more encouraged to bring up your bid into that trade? Absolutely. If you added some value to that, perhaps the idea of buying into this might actually be a good idea. And obviously the idea of understanding where fair value is, you can start looking to see whether there was any fair value in this. And you can see the answer to the fair value question was no. So when we add fair value to this, if this is your fair value line, would you have been selling at 83, in other words? Would you have been trying to sell at 84s? Or with the fair value collapsing like this, would you not have been keen to actually get into that trade almost immediately? And therefore you did get filled. Do you see how you start to form an opinion now? Based now on the fact that you've now got access to a fair value story as well as a bid and an offer? Your bid is still at the bottom edge. But obviously with the fair value dropping, what is going to happen to your bid? Your bid price is going to start moving away from the bottom edge, isn't it? It's going to start pulling. You're not going to bid 76s. You're going to start pulling away your bid on the next candle, and then the next candle, and then the next candle. You're pulling away your bids. So you actually ended up never being long. You never ended up getting long. And obviously that meant that as a seller, you were able to perhaps even add to your short sales and develop a leg lower. And as we add that value, can you recognize some of the other opportunities that professional traders may have had selling into that fair value drop here into that prior swing low would have been a very, very exciting tradable opportunity. And we can already recognize that going into that data release at 3 o'clock today, that there were other opportunities to maybe get short into a little tick higher here, for example, or into these little edges. The fair value suggests that we should be a no-brainer short. And whether you want to take a trade before a data release is a choice you make. So in other words, we start to form a way of being able to price the market from a price action point of view. We start forming a way to price the market from a value point of view, from a fair value point of view. And we start recognizing how to price the market based on a order flow point of view. So from an order flow point of view, from an order flow point of view, interestingly enough, when we're looking at the bottom edge of the S&P, for example, if I go along to the bottom edge of the S&P, there was another question, but we've already done this exercise enough. I think you've got the basic idea. So if I go along to the bottom edge of today's S&P here, and we start looking at this as a narrative here, and we start thinking about this storyline as it unfolded during that very, very sensational little drop phase, and obviously as you zoom into that chart and you start watching this as a storyline forming, take a look at the bottom edge here now at this point here. See it? Now think about the price action pricing of the market. Think about simply the price action pricing here. What are you starting to recognize that the price action is telling you about where fair value is, about where to bid? Well, according to these candles, if we've got a big red candle and the high of the red candles around about 52s and the low of the red candles around about 50s, it's about a 2-point move. And if you're coming into around about the 50s, you'd probably say realistically, I recognize that there's probably going to be a bid at 48, right? 2 points. And obviously with the value going up, that 48 becomes a firm bid, doesn't it? that 48 becomes an absolutely firm bid. And in fact, you may even start contemplating bidding this a little bit more aggressively. Now, as it turns out, it does run the 48. Not really surprised that it runs the 48. Why? Because obviously at 48 there, you can see we're obviously running the 50 stops, right? So they're obviously trying to get the sweep out of anybody that's left in this trade. Any early buyers perhaps get their trade off as well. And obviously the idea there is we start pricing the market at 48, and it's an aggressive buy at 48. What else? Well, the interesting thing was that there was actually very few sellers at that point. Take a look at the order flow at that stage on the S&P, guys. We can see the order flow at that stage in the S&P. Look at the delta in the background. There's actually very few sellers that have came in on the move below 56s, right? So whilst the market is quite clearly still selling, we're moving into this kind of free running to the bottom edge area. So in the market free runs like this, it's not dropping because of selling, it's dropping because of a withdrawal of bids. Big difference, right? And we can see the withdrawal of bids in the yellow line in the background, which is the top of the market book liquidity. So if the top of the market book liquidity is pulling off the bid and adding on the offer, then obviously that's going to form the shape of the candlestick. It still doesn't mean that the trade might not get jammed by some big commercial buyer. But if we can start recognizing the footprint of that commercial buyer, we can lean against that and take a buy trade against it. On this occasion, we didn't see it until we got into the bottom edge. We started to see a bit of a voltic reversal coming in at the very bottom print. And that was at a price just below 48, the price you had originally bid this market at. So when you see fair value, you start thinking about what price you're willing to bid and offer this. Now, we talk about two-way money, of course. So if you look at that price, it's not about what price you're willing to bid for it. What price would you want to flip this at? Well, according to the value at that stage, if we look at value at that stage there and we think about that value line, you're probably thinking to yourself, I think the sell value is probably north of 60 at the moment. Agreed? Would you agree that the sell price would probably be north of 60 based on fair value? Well, if I'm able to buy the S&P at that stage at 48, and I've got a flip at 60, I've got a 12-point move. I've got a very, very substantial $600 potential upside profit in this deal, right? So I know I don't have to cut my profits early. I know I don't have to worry about a stop at break even anytime soon. I just want to make sure I get my deal done. I've got a $600 upside, which you can all agree, I would imagine, if you did the exercise on pricing, if you did the exercise on fair value that we've just shown you, I think you could all agree that this trade has about a $600 upside trade. And even if the value changes, I still think I'm going to make some money on it regardless. Now, interestingly enough, this is where our referral back to the trade log can help us. Because obviously we want to know, because this is a bottom edge, this is a tough buy trade, guys. I'm not making any qualms about this. This is a tough buy trade. This is a bottom edge. And to try and buy a bottom edge at the best of times is a really tough gig. You're always better selling. And we give a little easy rule for everybody to remember in classroom. If you answer this question and you answer it accurately, you're going to make a lot less mistakes. How close are you compared to the bottom edge to the top edge? How close are you to today's low or today's swing low or session low compared to today's high or swing high or session high? How close are you? Wherever you're closest to, that's where you should be trading towards. So in other words, if you're closer to the day low, guess what? You should be predominantly selling. If you're closer to the day high or the swing high or the session high, you should be predominantly buying. That simple rule of thumb, that simple acknowledgement of that simple, basic, fundamental fact will keep you away from trying to endlessly buy bottom edges. But on the odd occasion that we had a big wholesale price like 44.50s, on the odd occasion where the value looks incredibly structured, incredibly bullish, we're starting to recognize that we may be able to get away with a buy at a bottom edge, but we recognize it's not going to be easy. But we obviously start thinking about the possibility, right? So let's take a look at what the trade log told us. This is the live trade log. The timing is all London. You can see there's a lot of stuff to get through. And this is why a lot of people asked Kim, I just want the trade log. I'm not really interested in education. Well, what the hell is the value of the trade log if you don't know how to bid for it? If you don't know how to put a bid in a market or an offer into a market, how do you know where to buy this trade log information? So when we look into this as an idea, you'll see it's 1755, it's 1753. You'll see that there's a future bid versus a sell and option volatility rotation from the dispersion trades. Now we know that that's the minor dispersion buy trade at this stage, the minor dispersion. There's 3 dispersion trades. This is one of the minor ones. It's 1753 and 1755. Well, interestingly enough, at 1753 and 1755, we've just ran the sweep of the stops, right? And we're getting this idea that we're going to be trying to bid the bottom edges, basically. But it doesn't tell you what price to bid. It just tells you that the dispersion traders are now looking at this as a bid market. You've still got to then use the auction. You've still got to then look at the valuation of fair value. The dispersion guys don't mean that there's fair value for the buyers of everything else. So we've got to build a story around that narrative, but at least it's pointing us to one of the stories at this stage, right? It's helping us to spot that somebody somewhere likes the buy opportunity. They're going to start bidding for it. It doesn't mean it's us. It means it's somebody else. So when I look at this dispersion buyer coming in to bid the futures contract, and I recognize the wholesale price at 44.50, and I recognize that we've now got this beautiful rotation from the big hedge funds, right? So we've got a hedge fund rotation. That's what this green line is. So we've got this hedge fund rotation, and I'm now looking at pricing this market accurately. And I look at the auction that I'm entering. I look at the size of the candles. I look at the size of the volume. Does that not tell me that those buyers are coming into the market now? That big book trader, that big liquidity trader is now coming in with that size of volume there? Absolutely. Was it valid here? No. Why was it not valid there? Because the value is still dropping. So it's not valid at that stage. If that's massive volume, which it is, then that's just profit taking, guys. That's just a profit taker. Can you tell the difference on your charts that it's profit taking or net longs? If you can't, you need to be able to tell the difference. So we know that that's profit taking. We know that this big volume here was profit taking, not short, not longs, not net long positions. And if you've got profit taking, you get what's called a short covering rally. And if you get a short covering rally, your job is to try and offer back down into it, right? Your job is to offer back down into it, right? And you start looking for those offers. You start looking for those offers, and you rally. Any rally becomes a sell for you. You price the market accordingly. You price the market against the next bid price, and you're now recognizing the drag of the 44.50 liquidity. You sweep into that, and the value is now bullish. So that big volume could be your first opportunity to start buying into this. Now, you don't know that big volume until it hits, of course, but at least you're now recognizing that somebody likes this buy trade, not just you. And that's going to help inform your opinion about what price to bid. Your entire success in the markets, guys, is going to be defined by your ability to bid and offer the market accurately. You can see that if you misprice the market, if you misprice that car from earlier, if you mispriced the car from earlier, you either got a terrible price if you started to bid at 20 grand. If you put in a bid at 20 grand, then of course the chances of you flipping that for a profit are what? Pretty close to zero, right? The fact you paid 20 grand for a car that's got a fair value at 10. So that's what happens in the market all the time. You know that fair value just now was below the market. So if you bid for this price here, if you bid against this big volume, do you think you've got any chance of flipping the market for a profit? Honestly, a lot of people will look at big volume like that and say, well, it's an automatic buy trade. Really? Automatic buy trade. And they look at this big volume and they say it's an automatic buy trade. So you're obviously at the present moment, as according to what's happening with the green line, you're buying above fair value. So what do you think your chances of making a winning trade are? almost zero, right? Your chances of making a winning trade are almost zero. As it turns out, the fact that there was big volume meant that somebody was taking profits, and because somebody's taking profits, the price generally goes sideways. And obviously, because the price goes sideways, you might actually be able to realistically get a scratch out of those trades. But if you think about any candle that doesn't have big volume, big surging volume I'm talking about. So for example, you start looking at this and it's retesting the lows and it's got terribly low volume and you bid that candle with the value now dropping, you can see you would obviously always lose money. And if you bid that candle, you would lose money. If you bid that candle, you'd lose money. And you can see that if you start bidding these low volume candles, you would lose money on pretty much every single one of them. So tell me again whether pricing the market accurately is important. Tell me again that recognizing the big dogs is important. Tell me again if that's changed your mind about how to trade the markets properly. If you're just using volume, if you're just using price action, what distinguishes these two buy trades here against the previous buy trades? There's no hindsight bias to it. The value is going up, and we can all see the value going up. I don't make the value line. So we can see that fair value is rising, and it's rising very aggressively. We've now recognized from the trade log into that storyline, we've recognized, my God, what's happened to the prices? Okay, so we've recognized from the trade log into that storyline, the value coming in, this buy trade, adding bids into this. And you can see what happened here, look. So we hit 1800 hours. We've seen the dispersion buyers coming in. And then at 1800 hours, look at what happened. The S&P market makers are now adding bids into discount prices. You see it? 1800 hours, 1801, another dispersion buyer comes in again. In other words, we're starting to look at that and say, well, at 1802, 2 minutes later, does that not look like the market maker adding a bid into the bottom edge? Does that not feel like the market maker is adding a bid into the bottom edge when you see the price action turning around very quickly? Because what's the market maker doing? If they're adding bids, they're pulling offers, right? If they're adding bids, they are absolutely pulling offers. Now, they only might pull the offer to the previous high. They might only pull the offer to that price, or they might pull the offer altogether. And as we start the candle going up into this area, then we get the Nash trade candle going up into this area. You're thinking, this has got a lot of room to go. Because now, based on the Nash exercise we're talking about, you see a big faking candle like this bad boy here, or even this trade here, and you think to yourself, well, I could actually press these, couldn't I? Based on the pricing process, you would easily have got filled in that candle, wouldn't you? And you'd have easily have got filled in that candle for the press against the value in the background, against the Nash equilibrium pricing. And obviously, based on that as an overall process, the last trade here was 50s, traded a high price of 53. So your offer at this stage is 56, right? So your offer at the moment is 56. And as the price trades 56, what happened to the value when the price traded 56? Well, the value at that stage was here, and the price of the value is a lot higher. So guess what happens to the 56 offer? The 56 offer goes a lot higher. You pull your offer again, don't you? And obviously, therefore, what happened to the price? We then traded into the 60, a wholesale price, a price that we know big commercials are going to always haunt. They're going to hang around the 60s, and they're going to look for a bit of business. Now, what happened around the 60s? Well, we can see what happened around about the 60s. If we look at the trade log, we can see that we started to look for S&P offers. At 1810, we started to see some S&P offers looking for a trade opportunity. So where's the S&P offer here at 1810? It's not the top edge. The fair value is up here. So the S&P offer probably is back up here at around about 61s. Do you see how we need to know this? Because if you saw that on the trade log and you saw S&P offers at 1810 and you say, well, I'm selling it. No, that's not what it tells you. That's not what it tells you. It tells you that there's dispersion desks looking to sell into this trade, but they're not looking to sell it right now. They're looking to price the market up. And if you look at fair value, is that fair value for a sell trade, guys? Not even close, right? It's actually fair value for a buy trade. So obviously, if these dispersion guys are going to come in, these are the top professionals of their desk, right? These are the top professionals on the planet. They're not going to come in until 60's gone bid at least. At least 60's gone bid. And obviously, as we start to scroll through, we start recognizing that as we come up into those price areas, you can start recognizing again that the dispersion traders are now coming back in again here at 1820. They're now looking to offer at that price at 1820s. And you can see that we already had a big volume break here, then 1816, 1817, 1819. So there's the dispersion trader right there. See it? 1820. The 1819 candle on a 1 minute candle is 1820. So we can now recognize that that is now the break of the 60. And if the value is good enough to go net short, and there's still a few questions about that it is good enough, I think, according to this movement here, you can obviously think to yourself, well, it's a little bit cheeky. I think the buyers that came in below 50, I think they'll be delighted to sell at 60 regardless, take some money. So worst case, I think we're going to get a sell rotation coming off that price. And you got a little sell rotation coming off that price. Didn't go very far. It rotated, as you've just recognized, it rotated. And obviously the value of that is still going higher. Do you see it? The value of that is still going higher. So does that not create a discount to buy into? Does that not tell you that there's a better discount starting to form into that low price where we recognize those commercials? And obviously we start looking to see if we get any signals in here. Now, obviously there was a lack of any volume and everybody crossed the spread aggressively here. And that's what created this enormous buy-side candle because fair value was rising. And if fair value is rising, what are you doing with your offers? Is your offer still at 61? Well, of course your offer's not at 61. Your offer's going to move in line with fair value, so your offer might be 65, right? Well, if your offer's now 65, if you can bid 58s or 59s or 59.5 or 60s, that's a good trade, right? You're still getting about a 5-point upside in this trade, haven't you? You're still getting about a 5-point upside. So we carry on. Futures bids, 1824. 1824. So obviously this is just this balance area, guys. So we'll take it along to this area here where we're looking for this opportunity. So we had offers coming back in at this top edge. You see the offers coming in here? Yes, offers, 37.38. So there's 37.38 right there. So the offers are coming back in. I don't like the offers personally. The dispersion guys obviously do, but I don't like them. So obviously that's up to them. So they sold into that and took the price down. And obviously when you see the 1842 area, bids, right? Bids, and bids again at 1842. So I like that bid because that's what I'm looking for myself. I love that bid opportunity. 1842, loads of them. And obviously buying into the 57 quarters, traded at a high price of 63 is beautiful, absolutely beautiful. And then we started to see a value divergence creeping into our pricing here. You see that divergence creeping in here? Now, obviously what happened was we got a little bit of a turn. Now, the reason why we got a turn is based on a macro story. Let's take a look at the macro in a second. Based on the macro storyline, of course, we've got another storyline forming. We've got this idea of macro ideas, right? And we can recognize that if I'm looking at this as a macro chart based on anything else, the overall shape of this price actually based on this idea here. So if you look at where the fair value is on a macro chart basis against that balance, the price of the S&P based on this narrative should actually be, and this is obviously us starting to become more professional because we're starting to build the story. The price of fair value should be 45 evens on the S&P, not 44.60s, right? So we've got this macro view at the back of our mind that we would love to buy into if only we could. And obviously this idea of buying into that macro fair value allows us to then recognize that these up moves are actually, right in line with what we would have thought macro-wise. Now, what else can we add to this as an understanding of a marketplace? Well, we can add a simple concept, and it's called the dealer spreads. When we think about a market, we think about where the dealers are bidding and where the dealers are offering. And every day we give this price out. We give prices out for the dealers. Every day we highlight where the dealers are positioning. Every day we allow you to think about those as opportunities. Every day you can make those decisions yourself. Let's take a look at the NASDAQ today and see how the dealers did. So when we look at the dealer keys here, we're obviously looking at the NASDAQ dealers levels here. So let's take a little look and see these levels. Now, how does this work? Well, we've already identified how it works. We've already shown you a basic idea of how this should work. So let's remind ourselves, how does it work? Price goes from one bid to an offer, and then from the offer to the bid, right? It goes between the bracket areas. That's how it works. So when we start looking at price and we start looking into these bracket areas, we're obviously going to be thinking about this as a basic underlying process. A basic underlying process that we can then use to figure out what the hell is going on, right? So if I was to do that as a process, let's think about what I got as a bid and an offer. So we can obviously understand that there's an offer at 615 and a bid at 520. If 520 goes sell side, the next bid is going to be at 440 and the sell is going to be at 520, right? So we start forming the opinion about where price goes from and to. Agreed? Happy with that? That's basically what we did, where the market bids and the market offers form the next candlestick. It might not be a candlestick, it might be the whole entire day, but it forms the opinion of the entire day. Can you please also note that this was sent out at 11 o'clock last night? In other words, this is, at this stage, 12 hours old. This information has been in the market in your hands for 12 hours. So it tells us that there's an offer here at 510, 520, right? It tells us there's a potential offer. Why? Because the price is below it, right? The price is below it. If it's above it, it's a bid. So if I look at the 510, 520 price level, can anybody recognize that that's quite an exciting price level? 510, 520, yeah? Can you see that the price is below it? So I would expect to see a sell coming in at this price. I might not see a sell coming in, but I expect to see a sell coming in at this price. I'm looking for the possibility of selling into that price point at around about 510, 520. Well, there's 510 and there's 520 on the NASDAQ today, correct? Got it? So we watch for that sell. We see the buyers getting absorbed and we start working offers against that 510 area. If they're going to sell the 510s, I don't think they're going to buy it back until 440s. I might be wrong, but that's certainly what the dealers are telling me, right? So I'm going to start thinking about my offer at that price, and I'm going to put my original bid at this price. Reasonable? What do you think? It's the dealer keys. It's their key reference levels, okay? This is the key reference levels that the dealers have. So I've got an offer at 510s and a bid at 440s. That's quite a sizable move if it happens, right? If I can sell at 510s and get 440s, 70 points on the NASDAQ, I'll take that, right? $1,400, damn tootin' right. So let's see what happens to the NASDAQ. It comes back up into the 510s again, and we get another opportunity to work that offer. And obviously, we've now got in mind that the price will probably now trade this 440 level. The price goes back up into our 510s for another offer, and then it trades to the 440 level. Unbelievable, isn't it? So the price went through the 440. So did you buy it? No, you let it go through. You just let it go through. And obviously, you've got to make a decision at that stage. And if you let it go through, where's the next buy coming from? 295. Well, what does 295 bring in? 295 brings in the 300 wholesale, right? So we're obviously thinking that this price is going to go for a lot of distance. This 440 sell, bearing in mind we originally sold at 510s, is now expected to trade 300. 200 points lower, guys. 200 points, $20 a point, $4,000 a contract. That would be nice, wouldn't it, if you could get $4,000 a contract from these trades? So obviously we're now looking at that 5,300 now, that 15,300, right? So we've got the 15,300 in mind. We're going to mark off a big area there because that's one hell of a drop to get into that area. So we know that they might buy ahead of the 300, they might buy after the 300, they might sweep it. We don't know what's going to happen, right? So we watch it. So what does happen to the NASDAQ? The price trades back to the offer price now. This is now the offer price. It trades back to that 440 level and starts selling off. Good news. If it goes bid against 440, then it's going to do 520, isn't it? So we're now sell side below 440. What happens? The price trades down towards our target price area, doesn't it? And then bounces off that price. You see it? You see how that turned out to be the bottom edge price, and that turned out to be the top edge price? You see how we got the opportunities to trade these as key reference points? Just like we obviously are discussing on this screen here, this idea that these are the dealer keys. So if you knew about that dealer key there, and you knew about the market pricing, and you saw that there was no bids here, you're immediately thinking, well, the bid must be away down here at 15,300. My God, I'm looking at a $4,000 downside, guys, a $4,000 downside. Now, does it always happen that it goes that distance? Of course not. Something will act on it, the value of change. But remember what we saw at the bottom edge of the S&P, the value changing? Well, that value changing at the bottom of the S&P at 1800 hours, remember? Well, that 1800 hours happened to correspond to the NASDAQ hitting that 15,300 price level. So it wasn't just a dealer's key, it was the fact that we were seeing real money, fair value rising on the S&P at the time. We were trading that dealer's key level where there is a real incentive for the market makers to buy into this, a real incentive. So obviously teach this in the classroom, but the idea here is that there is many ways of pricing the marketplace. There's many ways of trying to figure out what the idea is about where to price it, whether to price it aggressively or not. And we looked at this on oil earlier today in the classroom. And obviously we had this idea of the slope of the supply line was bearish on oil. We had the idea here that we were post-Brent, which was red. You can see the RGL in the background. RGL simply means the big boards. If the big board's red, we'd rather sell. If the big board's green, of course, we'd rather buy. So that gives us an idea that the sells are all press trades. If we're going to buy it, it's going to be a fade at a bottom edge. And we can obviously start looking at this idea of the volume profile for edges and presses. We can add the idea of looking to sell off these edges. And we got a brilliant short sell on the oil price today based on fair value dropping. You can see fair value was dropping into the London Open, and that's how we managed to get a $1,000 sell trade, by adding to that position as it drove lower. So it's not about one event. You've already seen what I tweeted out about the bond price last night and how that bond price traded into a $1,000 upside profit for anybody that knows this stuff about informed trading. We've now recognized that this tweet from 17 hours ago and 18 hours ago, you can see the timing again. There it is, 11 o'clock last night. You can see that this is 1800 hours today in London. So this is 19 hours later. 19 hours later. Well, this price doesn't disappear in 19 hours. This is fixed for the day. And as this price is fixed for the day, it doesn't mean they're buying here. They never bought here. But it was quite obvious looking at the price action and how the price was moving. It was quite obvious that they weren't going to buy that. It just sailed through it, right? So they're obviously not buying it, which means that there is a lot of sell pressure coming into that narrative. If they don't buy this, that's really bearish. They did sell this, which made it really bearish in the first place, which meant we ended up with a $4,000 per contract NASDAQ sell-off from a tweet that came out 14 hours earlier than this top edge here. In a full 19 hours before the bottom edge. Talking about right-hand edge trading. Talking about hindsight. 19 hours ahead of these levels. Hindsight. Seriously. It doesn't mean you're going to buy them. It doesn't mean you will buy them. What it means is that you're aware of them, and that's all it means. I'm not sitting here saying you would have bought this trade at 1800 hours. But if I just remind you very, very briefly about that trade itself, if we remind ourselves that at that stage, that S&P really was starting to change around, wasn't it? The S&P at that stage really was starting to show up as a possible bottom line buy opportunity. So we remember we looked at the S&P and we looked at the green line in the background and we started to recognize that change to the story. Remember, we started to think about what that change to that storyline meant for us as traders, and we started to think about how we could use that knowledge. Now, obviously, it's up to us to then recognize the story. It's up to us to recognize the rest of the stories that go along with every single one of these trades. It's not that easy. we've still got to make the decision to do the deal. We've still got to make the decision to get involved. We've still got to get into that bit of business. But we saw the green line rising about 20 minutes earlier than that, 30 minutes earlier than that. We saw the green line starting to turn around, that fair value line that we were talking about. And as we started to see the fair value turning, we obviously started to recognize the opportunity. There it is, look, 1800 hours. Fair value turns at $44 at $44.50, right? $44.50 fair value turns. And at that point there on the NASDAQ, not on the S&P, but at that point there on the NASDAQ, we were trading that dealer key. So now we've got a dealer key in here, as well as that value line from the global macro funds going up. You've now got almost that perfect fade opportunity, which obviously was one of those pro trades. But look at the fact that it still took quite a lot of buying to get the market moving off the bottom edge. So as a pro trader, you recognize that this can take a while. As it turns out, it was only 20, 25 minutes, 15 minutes, whatever. It wasn't instant. But once the market started to go bid, it was a very, very rapid ascent back to the upside, wasn't it? A lot of money. Is this valuable? Kim always asks us to look at the idea of how valuable this is. And one of the things that we talked about, again, was this ability to add to winning positions rather than add to losing positions, and how very few people actually do it. If you add to a winning position, it's dangerous, a lot of people think, because if you add to a winning position, you've got a chance of giving back an awful lot of money. Well, guys, that's what we're here to do. We're here to take risks based on probabilities. We don't just randomly add to winning positions. We add to winning positions when we're making money, because obviously if we're making money, we're right. Our trade decision was correct to add to the buy side bottom edge. So therefore, it's likely to stay correct, which is the Nash equilibrium. If I bought at 10 and the price is now 20, what's the chances that if I buy at 20, the price will trade 30? Very high, correct? Because that's what we just did as a Nash equilibrium trade, didn't we? If you've got a green candle that the low price was 10 and the high price was 20, and I said to you guys, price up the next candle, you would say, right, I'm going to bid at 18s and I'm going to offer 30s, correct? You see what happens? The buy trade that you've got on, you can add to at 18s, and the high probability you're going to trade 30s. And if it doesn't happen, the Nash equilibrium, as far as game theory is concerned, the Nash equilibrium is now broken because something has acted on the price that you didn't expect to act on the price. If you knew something was going to act on the price, of course, you wouldn't have taken the damn trade in the first place. But you don't know that all the time, and therefore you react to events as they develop. But how can you react to events unless you know what that reaction is? How can you react to the bottom edge if you don't know that it's a bottom edge? Because price action tells you, because a stochastic oversold tells you, because of a MACD divergence tells you? Of course not. That doesn't price the market. That just tells you what's happened before. In other words, what we use is we use the professional approach to trading, which is pricing the market with a bid-offer spread according to the current price auction that we're stepping into, according to our assessment of fair value, and according to the type of auction we're stepping into. In other words, what kind of delta are we seeing from an order flow perspective? 3 key ingredients to pricing your market accurately. And if you can price your market accurately, guess what you can do? You end up looking at a car like this and you end up saying, well, there's a bidder in here at 8s. Do I want to pay 9s for this car? Do I want to pay 9s? You know what? I think I can still do okay if I pay 9s. If you've priced the market at 2 and somebody's bidding 8, you're not going to buy this, are you? In other words, you're not going to be able to make any turn on this. You're not going to be able to trade. You're not going to be able to make a deal. But if somebody's paying 8s and they're still paying 8s and the auction slowed right down at 8s and you say, you know what, 8,100. And then you see if anybody's willing to go over that 8.1 and they might pay 8.2 and you say, well, you slow the auction down. You slow the auction down. If you come straight in at 8.3, the guy might say, what's this guy know at 8.3? Seems very, very eager to buy at 8.3, so I'm going to go 8.4s, and suddenly the auction kicks off again, doesn't it? So the pace of the auction really becomes quite important. The auctioneer's trying to drive, any more bidders here? Who's bidding for this trade at 8 evens, 8 ones bid here, now traded at 8 ones. The auctioneer's trying to generate that upside move. The market maker is trying to generate that upside move with the limit order book, the inside market moving. But you know what fair value is. And if the price hits 9, you're out, right? You're not going to bid anymore. Price hits 9, you're out. In other words, that discipline starts working for you, because if you bid 9.5 and you can guarantee you get that car up the road, you know there's going to be something wrong with it, right? You know there's going to be some money you're going to have to spend on it. So it's not just 9.5. You now have to spend $1,000 on it. Now it's cost you 10.5. You're hoping you're going to get 11 out of it. But now you're right in the mix here at fair value at 10, and you've just now spent 10.5. Your chances are you're not going to be successful in this flip. And if you do that trade every time, if you do that trade every day of the week, you're probably going to be out of business by the end of the month, right? Sometimes you'll make a little bit, sometimes you'll lose a little bit, sometimes you'll make a little bit more, sometimes you'll lose a little bit more. But because you're not getting a genuine edge to your trading, you're not making any money flipping cars. Well, trading the markets, oil, gold, bonds, equities, is exactly the same. If you haven't got an edge that you can define, if you've overpaid where because you don't know how to price the market properly, if you've bid for something that's way above fair value, you're not going to make any money going forward, are you? Is it not time they started to take the professional approach? I'm not saying everybody's going to have the same bid and the same offer. You won't. Some of you will be more aggressive and some of you will be less aggressive. Some of you will feel good today and some of you won't feel good today. Some of you do a lot of trades and other people don't want to do a lot of trades. Somebody wants a bigger discount. Some people are willing to take a more of a risk. Every single one of you today will have a different opinion and a different view of a bid. So if I asked every single one of you about this trade, and I say that there's a phone bidder at 8, and that's the highest phone bidder I've got, and every other person in this room was all the other bidders, you might find that there was only one person that was willing to bid 8.1. And you might find that everybody else was trading, say, at 7.9, and somebody else said 6, and somebody said 5, and somebody said 4. Well, obviously, if that's the case, who's to say that any of these trades are wrong? Nobody, right? It's just that that's what your opinion of that fair value was. So the only person that got traded was this guy here, because obviously it's the top trader that gets traded, right? It's the top trader that gets traded. So obviously that's the trader that gets the car. Now, obviously, if it's still below fair value, that's a good deal. It's a good deal. But you needed to know what that fair value was first. Does it mean all of these guys were wrong? No, it just means that they were maybe a little bit too passive. Perhaps that's by choice and perhaps it's by design. Perhaps it's just a bad idea that they didn't know what the value was. In other words, they then learn something. They learn that if they're going to step into a market, they must always know what the value is. So for the people that are new to us, if you've never came across us before in the market space, when you looked at your oil charts today, or your S&P charts today, or your Forex charts, did you know what fair value was today? Did you know whether you were trading at a discount or a premium to fair value? Did you know how much of a discount and how much of a premium to fair value you had on your screens? And therefore, were you bidding in the right location and selling in the right location? Were you able to maximize your gains or take the maximum positions at the right time with the biggest discount prices? Did you enter the right kind of auction at the right time, at the right price, with the best view of where this price was going to go to? If you didn't, which might be the reason why you're here, I would imagine it's not just to waste your time and waste everybody else's time. I would imagine if you genuinely didn't know about the pricing of the market, about fair value, that's why you're here. Well, congratulations, you've just found the outcome. The trade log allows us to get some of that information provided to us. The trade log allows us to start thinking about where somebody somewhere is bidding or offering for this. You know, we look at the trade log and we look at the gold bids coming in at 1855 and we say, well, there's a gold bidder coming in at 1855. Did this gold bidder at 1855 have any idea about what was going on. I mean, was there an opportunity for me to deal there? Was there an offer that I could have traded at that stage, or was there a bid that I could have taken advantage of? I personally didn't like it. The fair value, in my opinion, was still selling. It was at a day low, so I don't know where the bid is. So I start thinking I'm going to bid 40. So when I saw that bid coming into fair value, so I saw this gold bid coming in here at 1855. Take a look at fair value. Where would you bid if you're looking now for that trade at 1855? Look at fair value. So would you bid this price here at 42.5? Would you want to bid 42.5 at that stage? No, right? There's no way you're going to bid 42.5. It's at session low. There's no way you're going to bid 42 in a million years. If you're not going to bid 42.5, where's the next key price level? 40, correct? So the next key price level is going to be 40 away from that price at that stage. So you're saying to yourself, I'm going to bid 40s. So you then start bidding 40s. So in other words, is the trade log alone enough to make that decision? Of course it isn't. So if you don't know that decision, you're maybe going to bid this price. And if you bid this price and then this happens, you'll be saying, oh, that trade never worked out for me. Well, it turns out it did, because at 1855, the gold price actually did rally. So even if you did bid it on that 1854 candle, it went 42.60s to a high price of 43.3s. It still made 7 ticks, big fecking who, right? But it still made money, if that's what you're interested in. It still did give you that little cheeky bit of upside, at least giving you a stop at break even. But the point is, you would have never bid 42. You would never have bid 41s, because the fair value is away down here, according to the other drivers in the market. So if you just simply do the trade log on its own and you don't know that, you're now going to look at it and say, the trade log's not very good. No, it's your pricing that's not very good on that trade. It's your pricing. The trade log's only telling you somebody's bidding. It's not telling you that they're bidding at a certain price. It's telling you that there is a bid coming in, and your job now is to try and find it. I don't like any of the bids. If this value was still dropping and we hit 40, I still wouldn't bid 40. Not a chance. So in other words, we've got to have the ability to interact with that as a storyline. I don't know if there was any other gold trades at that stage going forward. There was a gold bid at 1919. Okay, so we can obviously look for the gold bid at 1919, and we can see that there's 1919 right there, correct? So there was a gold bid coming in here. So that's a little bit better. Why? Because there's at least a little bit of volume coming into gold now, a little bit of volume, finally. So yeah, you can see that the green candles in the background here, that means that there's volume coming in. So yeah, it's quite obvious that we're now seeing that buyer coming in. We're now seeing a possibility that that price is now a bid. But again, it's into a fresh low price. It's a dangerous buy in anybody's book. The value is still dropping here, so it's still a little bit difficult to buy into. If you did buy it, you obviously bought it perhaps around about 41.5. The low price was 41s. It was a 5-tick drawdown. And obviously the price went from 41.60s to 43s for approximately a 16 tick profit. $160, $50 drawdown. Reasonable risk reward return, right? Gold, 1920, again a bid again at 1920, a bid again at 1920. So there's obviously a few buy trades coming in the gold here. And one of the interesting things, of course, was why you might buy this. Take a look at the trade log above it. The knob spread. The knob spread started to find a commercial buyer coming in. Now that's interesting, because if the knob spread is expecting a commercial buyer, that means that they expect interest rates to fall. And if interest rates fall, we know that that's going to have an impact on gold prices. We know gold will respond positively to that news if that happens, right? Gold would respond positively to that news. But that's you becoming a professional trader now. You're now looking at interest rates as an impactor on your bond price and your gold price as well, an impactor on your dollar price. And if it impacts your dollar price, it impacts on all commodity prices. So you start recognizing that knob spread steepener possibly going to be bullish gold. And then interestingly enough, also at 1920, we saw that the guys on the STRS desk, the STRS short-term interest rate guy, right? Short-term interest rate traders. The guys on the STR trade expect rates to fall, which is obviously bond ZB to bid on the drop, right? So now with interest rates expected to fall, is that not bullish gold as well? Of course it is. So we start building a picture around this that it's bullish gold, but we still recognize that it's still a hard buy, right? The idea that the yen is collapsing or the dollar's giving us this or whatever's happening, we still know it's a hard buy because it's still into a red market. It's still at a bottom edge. We've still got to be really careful about overbidding for this position. So we use things like order flow, we use leans, we use these ideas to then recognize the opportunity. You can see at 1925, we're still getting the same story. 1925, there it is right there. It's the bottom tick price. So now we're using something from the short-term interest rates world to trade gold. We're using something from the short-term interest rate market to trade gold from. And we're looking into the possibility that this is a genuine buy opportunity. 41s, which traded 43 for $200. Is that the kind of trade that appeals? Is that the kind of knowledge? Is that the kind of information that now appeals to you as a trader? Is that useful to you as a trader? Perhaps not, in which case, good luck with whatever it is you find useful. No problem for me at all. But the point is that we've got to start recognizing the opportunities that do present. The idea that tying this knowledge together here, recognizing that this is a very strong idea for a long gold position, starting to build here, and starting to then have the clues and the tools. Because if you look at how to price the gold at that stage, you'll see that there was a very noticeable slowdown into the bottom edge. So if we go back to that as a process, a very noticeable slowdown into the bottom edge means that every time we come across a new Nash candle, what happens? Well, obviously, when we've got these large candles coming in here, then if I was to draw the Nash equilibrium against those large candles, you can already recognize that the idea is that the bid isn't going to come in until that price there, right? And because the value is still dropping, I'm not going to firm up that bid, right? I'm not going to firm that bid. So when that candle appears, guess what happens? I'm going to start dropping my bid again into the markets. So I start thinking about that as a bid. So when that smaller candle appears, guess where my bid is? Stays at the same price. Because if I take that small candle there and I do a Nash equilibrium against that candle there, or that candle there, where's my bid price? Based on the exercise we just did, my bid price is now there, correct? So it's the same price. So in other words, the bid price stays static in now. The bid price is now static because the candles have slowed down. And obviously, we're still taking a gamble on this because we've still got a bit of sell-side pressure coming in here. But now we're starting to see that the bid price is not moving. And we're now seeing this storyline building from the fact that the bid... So why is the bid price not moving? Is it because of this storyline here? We start tying the two things together. Have you ever had the ability to tie those two pieces together before? If you have, I don't know why you're here, because you should be a very successful trader if you have, because this is what professional trading should be like. Tying the pieces together, the jigsaw puzzle, making sense. Not because of one piece, not because of the trade log, but because the trade log in combination with the price action, in combination with the volumes and price in terms of the other elements, and in terms of the order flow, start to lean against each other as a trade. Ask yourself the question, are you pricing your market accurately? Now that you've seen how to properly price your market. Are you bidding and offering for every candle? Have you got the ability to bid and offer for every candle? Do you do it? Because if you don't, you're not even close to joining the ranks of the professionals unless you're a pure systematic trader. But if you want to learn how to bid for the market accurately, if you want to go through the steps that take you to that understanding, if you want to go through the steps from an intern to an intermediate, from an intermediate to a pro, where we start evolving with the ability to bid and offer the market accurately, anytime you step into a market anywhere, you're accurately able, whether you've only got price action to go on, or whether you've got price action plus volumes, price action plus volumes plus delta, price action plus volume plus delta plus fair value, plus the trade log, plus the outside markets. If you've got all of those tools, your ability to properly price the market, therefore not overpay and not underpay, because if you underpay, you don't get filled. If you bid 4, you bid 5, you bid 6, you don't get filled. You're hiding. You don't get filled on the best trades possible. This is a good deal if you can get it for 8 grand. It's a rotten deal if you get it for 10. If you don't know that about your marketplace, you now know where you're struggling. You know why you're struggling, because you're not properly able to price your market going forward, guys. I hope that makes sense, because that breakthrough, that ability to properly price is something you don't just get from a classroom. You get from repetitive, over and over again of doing. The exercises, the process, being exposed to this every day of the week, being exposed to this every time you step into the classroom, me forcing, some of you still won't do it, some of you still get it wrong, and some of you still lose. There's no guarantees. You might be just bad at trading. You might be bad at market making. You might be bad at pricing. You're going to struggle unless you can develop into a very, very, very systematic trade outcomes. But if you can get it, you've got the keys to being a successful, consistent trader. Sometimes you'll lose and sometimes you'll win, but on net basis, you should win. You should be making a good life out of the trades that you've got. You should be taking them for the maximum. You should be getting into them. You should have confidence about the bids and the offers that we've just covered with this idea of pricing. Have a think about it, but have a serious think about it. It's easy to dismiss another classroom. It's easy for the trolls to come in and say this isn't what trading's all about because they've made a fortune. Well, why the hell, if you've made a fortune, do you waste your time coming in to listen to this? This isn't the only way of trading, of course. There's lots of ways of trading. I'm not going to knock anybody else's style. But what we're looking at here is the way that the vast majority of professionals trade as far as commercials, as far as market makers. If you don't believe it, listen to a very famous trader called Charlie D on YouTube. Charlie D was regarded as the best floor trader on the bond pit that ever existed. And Charlie D talks about these exact points. He talks about the big dogs. He talks about recognizing where the big dogs are located, and then he recognized why they were located at that price, and he started to recognize that he wanted to now be part of that trade. And it was only when he did that, after about 2.5 months of being on the floor of the bond pit, that only after 2.5 months, so we're doing intern to pro in 100 days. Charlie D did it in 2.5 months because nobody told him this information. Nobody was able to inform him. He came across this information by himself, by observing. So it's not going to take you 2.5 months. You're going to short circuit by coming in here and learning this. But you will ultimately become the same type of trader that Charlie D was. Did Charlie D win every day? No. Was he the most legendary trader on the floor pit, the floor of the bond pit? Absolutely. Absolutely. So do you want to replicate him? If you want to replicate them, guys, he talks about it on his webinar on YouTube. It's not the best quality. It lasts for about 1.5 hours, 2 hours or something like that. It's a terrible quality, but if you listen to it, it's the only thing that's existing of Charlie D in the olden days. And he talks about this very process, this idea of bidding and offering, this idea of pricing the market accurately, this idea of going in for a bid and then scratching it too early because he doesn't know what he's doing. You don't have to believe me. You don't have to trust me. You can listen to Charlie D for what it's worth. And I strongly recommend you do. But at that point, guys, we've kind of overstayed our welcome. I think we suggested that we try and get this wrapped up for 9 o'clock. It's now 10 o'clock, so I've overstayed my welcome. Kim's way past our bedtime by now, I think. So I'm going to pass it back over to Kim. She's going to tell you how you can possibly, if you're interested. If you're not, good luck to you, by the way. I don't have any problems with that. If this isn't something for you, if you think it's not the right trading style for you, I'm good with that. That's not a problem. I don't think it's because you're mad, and I don't think it's because you're bad, and I don't think it's because you've got the wrong system. If it's not for you, it's not for you. No great shakes. But just accept for 1 second that it might be right for some people. It might be right for where they are in their journey. It might be right because it answers some traders' questions. that they're struggling with as a trader. Why is this not working? Why does my stochastic not work when this type of market develops? Because it's got nothing to do with that, is it? There's so much more than that process. Anyway, I hope there was something of interest. I hope you were able to buy this Ford Edge. Congratulations if you were the guy that bid the $8,100 for that Ford Edge and you were able to flip it for 11. It's yours. You can collect the keys at the desk. Just don't enjoy it too much because you've got to flip it, guys. You've got to get that car sold. So I'm sure you're not going to enjoy it that much. Get it flipped, make your profit. Anyway, enjoy the rest of your day. Enjoy tomorrow. If you decide to join us, I'll see you on the other side. If you don't, best of luck, guys. Best of wishes. And I hope whatever you do decide to use works for you as a trader because everybody's different. Everybody's got their own style. So I'm going to say in the meantime, I'm going to say adios, amigos. Arrivederci. Auf Wiedersehen, sayonara, tutsins. Tascado, dos vidania, and spasibo, guys. In the meantime, ciao for now.
Thank you so much, Ray. That was excellent. That was really, really good. It's so important, I think, so often. Just a second here. Got to make sure that I have the other so I can bring up the slides to let you know about the class. But thank you, Ray. Appreciate you so much. Wasn't that good? And yes, we will have this session is being recorded. So I'm going to go ahead and bring up the screen. For those of you that are new to us, let me know in the chat. Hope you enjoyed that. I thought that was great. I thought that was so good. It's one of those things that years ago when Ray brought that up, I thought, oh my goodness, that's kind of one of those like V8 moments when you're like, I wish I would have known about that before. Thank you, Bright. Yeah, Ray does such a good job, but he brings that reality, being a quant, so I'm going to talk about our intern to pro, as Ray was showing. As you can see that baseline, when everybody comes in, he's going to give you the information so that you can do some systematic, as you're building. That way how to get it right. You can go from there. As Ray always says, those exercises aren't meant to be your trading, but they're can give you a baseline of where you are, what you have to get better at, but have a building block and a foundation. And the one thing, a couple weeks ago or so, when we were talking about this and Ray was talking about, the one thing traders need is time. So that's why we're having this 100 days, and it's going to be the reality of experience, because he says you guys need to do the exercises, get on there and really see for yourself, that you can see it. Because if you just listen to him, you could listen over and over, but that's not going to be the same as you writing it down or listening to it, getting on your charts, spending that time. So often people, really skip that step of learning the auction process, like Ray was taking you through today, the process of pricing the market. And, when you stop, I know some of you have to be sitting there thinking, I've never thought about that before. I just look at my chart pattern or my indicator or whatever, and I take a trade, never thinking about, where fair value is. And I've always loved that concept of him saying, do you have buyers above? If you're buying, the easiest, make sure there's some above you, make sure you have a discount so that you can get there. And it makes you understand why people get in trades and they're buying at the top of the auction. It goes against them. And I always said, after about that first month of working with Ray, and this has been 9.5 years ago, and I thought, oh, this is so different, but what jumped out at me was the why. Everybody teaches how, but he provides that why to back that up. And I think if you sit here now and think to yourself, that was really different what he was doing, but what was he giving you? He was giving you both sides. if you can ask the right questions, the answers change everything. So super important. And as Ray was, laying out there, trading's a game of statistical probabilities. So if you stop and think about that and you know what your probability is, what your edge is, you can start to, execute with confidence, and it starts building and you become more and more confident. And so my whole goal was, why do we pick 100 days? Well, if you can think about, trading and getting 1% better every day, and that's just the challenge that you're going to give to yourself of each day saying, I'm going to get better today. That doesn't mean that you're going to make 100%. It means that each day from where you are when you start this program, that you're going to commit to getting 1% better each and every day. I think at that point, you think about compounding it all, I think it's going to be good. So, as Ray always says, the secret to trading is doing, and doing these exercises, getting over, you know, challenging yourself and to get better every day. So I think that's what this program is about, of the intern part of taking you where you are now, you accepting where you are, knowing what you're going to have to do to, to get better. And we work on that, as there's so many different ways. That's one thing Ray has shown us over the years. There's so many ways to make money, and everyone has different skill sets, comes from a different place, have different amount of time that they can trade, different amounts of money, emotional baggage. There's so many different things. So it's why there's not just one way to make money. And you find what your base is and you build from there. Because even in our trade room, some of the guys that are in here to that have been in here for a long time will tell you, we can take two bond traders, and while the base of what they do, the principles that they work from are going to be the same, but what they use for their elements, their trigger, can be very different. So I've seen that, and I've been able to see that they use the right principles. You're not going to have one of them long and one of them short at the same price, but you will find them doing different things, and they both can be successful. So I think that's important, that what Ray's given you is the ability to build your own foundation, to build your own plan, and then at the end, you'll have your own blueprint to grow from, whether that's to stay in the group and continue that path, or to, work it on your own. So that's what we're doing. We're having an intern to pro boot camp. We started this, last week we did a session. We offered like a fast action. If you come in, we're giving you an extra bonus month. And so then instead of 100 days, you're going to have, look at that, you're going to have 130 or something like that. You're going to be in through the end of January. So that's going to get you the first part of next month, or of that month of the new year in 2024. And uh, we do now have, because last week on Friday, Ray did a new trade log orientation. So you already have fast action. You can on demand get access to that. And we have our order flow. And you probably saw some of the tools that Ray was showing. We have an incredible group of traders that have shared their talents. And the one really unique thing is all of the indicators that we have been developed based around Ray's teaching. So Ray has really taught the group, you don't just go buy an indicator because somebody shows you something. You buy the indicator because it's showing you something that you're looking to see. So very different. I think a lot of traders buy an indicator because they believe it knows something they don't. And so it's their way to lean on that indicator. Whereas if you buy an indicator or you use an indicator that you're looking for something specific and it shows you that, then as the markets adapt and change, it can have, you're able to adapt with it, because, newsflash, markets change all the time. and it's why you've got to continue to grow and all of that. So real quick, you can go to compassfx.com/100 days. You can reach out to me, Kim at compassfx.com. Catch me on Skype, Forex Kim. I'm going to make sure to answer all the questions. I see some questions in here, but I'm going to go ahead and, for now, stop the recording because I think we've got this part. You can go in and you can schedule actually a call with me. I already have one scheduled this evening. Looking forward to that, Aaron. But I'm going to go ahead real quick, guys, and I'll get this stopped, and then we'll just keep on rolling here.